Hi, my name is Doug Baird. I'm the Chief Financial Officer for Coastal Solar. I'd like to take just a few minutes to tell you about one of the greatest investment opportunities that I've seen in a long time and show you a financial spreadsheet that I put together for some of our clients and just go through the numbers step by step. So we'll start out with number one, good place to start. We use your anticipated tax rate to multiply it against the depreciation to give you more of a cash-on-cash understanding of what will be the actual liquid money that will fall back into your pocket. And what I mean by that is the ITC, the investment tax credit, is a dollar for dollar credit against your tax liability. So if you owe a dollar's worth of taxes, you obviously would be able to offset it 100% by the ITC. A dollar's worth of ITC will offset a dollar's worth of tax liability. The same is not true with depreciation. Depreciation is a deduction. So what we do is we multiply that number by your anticipated tax rate, and that gives you the cash-on-cash return that you can expect to have. And this really drives our numbers because when I show your initial investment, and if we can go ahead and look at the spreadsheet, we're talking about a project size that's a little over $360,000. So that will be your initial cash outlay. And then what we do is we show you what will actually come back in your pocket over the next 25 years. Now, obviously, the ITC is going to come back really quickly that very first year if you have tax liability. Now, if you don't have tax liability right now and you're planning for the future, you get a 1-year carryback and you get to use it 20 years carrying forward. And the salesperson or myself can adjust your spreadsheet to reflect that so we can get you an accurate internal rate of return. But let's just presume for now that you have a tax liability that you need to take care of right away. So you'll receive, most of you, if you'll look at number one, that's the anticipated tax rate. We'll move on to number two now. That shows you the right-hand column there that actually gives you the cash-on-cash advantage, the liquid money that will come back in your pocket. So the very first year, it's really compelling, and this is what drives the internal rate of return through the roof, is you get approximately 76% of your money back the very first year. I don't know many investments that you can make today where you'll get that much money back in your pocket after your initial outlay, and it really drives the internal rate of return through the roof. Now, there are several different situations that we deal with in our financial projections. We don't know if you have already used your Section 179. It's $500,000 per year. So you may have bought some equipment, $200,000, and you have $300,000 left over. That will really drive how we handle the rest of your depreciable asset. So if you have used $200,000 and you only have $300,000 left over, obviously we would take the balance, the $67,000 in this project, or $67,200, and we would move it into 50% bonus depreciation. If we had more left over, it would waterfall down into the makers. So each customer has a different situation, and we try to customize the financial projection to get it just as accurate as we can. We also like to sit down and work with your CPA. So we really want you to feel comfortable with the numbers. Having said that, this year you may have spent $100,000 on a tractor, and you only have $400,000 left over. We would apply that $400,000 to the project, and in this particular case, you're spending $367,200. You would write that off completely in the very first year. But let's say, for example, you're dealing with a system that actually costs $700,000, and you were able to write off $400,000 of it. That means you would have $300,000 left to waterfall into these other depreciation methods. So the next one after Section 179 would be the 50% bonus depreciation. So we would take 50%, up to $300,000. We would write that off the very first year. And then the balance, the next $150,000, would waterfall into the makers. And it's the modified accelerated cost recovery system. and this is a schedule that the IRS has set up for solar cost recovery and depreciation. So that is the waterfall that we use. That's the method we go through when we build these financial forecasts for you. I hope you're pleased. I would like to say one more thing about the PV income side. That is pre-tax. It's not post-tax. The reason why I handle it that way is you have several different methods for your PV income. Some of them are avoided cost. Some of them are actually net metering, and they'll be taxed differently. So I'll leave that up to your CPA to handle that. In addition, if you do have avoided cost, you won't have the benefit of that deduction going forward. And sometimes the actual interest expense, if you choose to finance it, will offset that by, sometimes 60, 70%. So in those type of situations, I like to work with your CPA to actually find out, what it will be taxed at and if it's taxable. Thank you for your time. I really get excited about the numbers. I was a businessman myself, and I was profitable, and I was always looking for ways to reinvest back into my company if I could. Taking your money and putting it in a CD and getting 1% is no fun. But when you can reinvest back into your company and achieve an internal rate of return of 15 to 20% and have an asset that will last 35 to 50 years and it's warranted for 25 years, that's a really strong decision. And so we try to build a model to help you understand how it makes sense. Thank you.